Thank you, everyone. Just as a brief introduction, I've been managing the India Capital Growth Fund for almost a decade now. I'm based out of Mumbai in India, and we have a strong team in India managing money for the fund. For those who are not too familiar about us, we invest only in Indian equities. We're fairly differentiated in the sense we play in the mid and small cap segment of the market. And it's a segment where we find a lot more opportunities. And by structured as a trust, it helps us a lot because we're able to invest in relatively illiquid companies and ride it out for a long period of time. So I'll really start by giving a perspective of what's happening in India. And the best way to do it is to really give you a perspective where India stands versus the UK. In terms of GDP, India is very similar in size to the UK. In fact, India is slightly ahead of UK in terms of size. But that's where the difference ends. I would say the big difference is that India is a very young population, 600 million people below 25 years of age, a billion below 35 years of age. So demographics is absolutely no challenge in India, which most other countries are facing. I think the second big difference is the growth. India has steadily been growing at 6 to 7%. And even in this current global environment of uncertainty, India is possibly the fastest growing large economy. And the third is India is actually not much of a levered economy at all. So what's the story about India? It's really all about growth. And I'll give you a perspective. This chart shows the ranking by the World Bank of companies by size of GDP over different time periods. The orange line is that of India. And what you'll see is that over every 5-year period, India's rank has steadily been improving. What's more important is over the next decade, India is projected to be the third largest economy in the world. So it's going to be ahead of both Japan and Germany as well. But that's the long-term picture. If you look at the shorter-term picture, IMF forecasts of growth for the next 2 years of all large economies. And you'll see the big differences today. India is actually growing faster than China as well. So what's driving this? Our own belief is this is not a one-off phenomena. What we are entering is a very strong structural growth phase. So why do we say this? I think for that, I'll just go back a bit in time. And what's really happened is that the economy has seen a very big transformation over the last 5 years. Two things have happened. The first is there have been a lot of reforms. And why this was possible was that in 2014, when we had elections, after 30 years, we had actually a stable government with a single party majority. So tough decisions were taken, and everything from tax reforms to banking sector reforms to real estate sector reforms took place. I would say almost every sector was touched. The focus was to bring about transparency, use technology to reduce the role of the government and make it simpler to do business in India. But it was very disruptive, simply because the old way of doing business changed. You couldn't use the political network, you play one bank against the other. And what it led to was huge disruption. Number of companies in the steel, cement, large industries actually folded up. The banking sector took a big hit. What you see on the side on the left is the non-performing assets of the banking system. It went up all the way to 6%. But today it's a very clean system. You had 4 years of cleaning up the banking sheet books, and they're sitting on the best ever asset quality in history. The same happened to the corporate sector, where profits collapsed. Companies focused inwards on cleaning up their balance sheet. And what you saw was profitability came off, but leverage also came off. And today, again, the corporate sector is sitting on a very clean balance sheets and profitability back at to earlier peaks. What I'm really trying to emphasize is by the time COVID happened, the Indian corporate sector was on possibly its best ever balance sheet situation. The second aspect of the reforms, and I'll stress a bit about this, is that India has also rolled out one of the most sophisticated digital infrastructures in the world. What's different between India and the rest of the Western world is that the digital infrastructure is actually owned by the government. So it's very low cost, very high volumes. And it has 3 legs to it. It really started with the government realizing that a lot of Indians who were born in the smaller towns and villages actually had no identity because there was no birth certificate. There was no documentation to say who they were or what their address is, what their birth is. So they created something like a social security number, something called the Aadhaar, where everyone has a 12-digit identity. You've taken their photograph, they've taken the biometrics, the fingerprint, the retina scan. And today, every Indian has this 12-digit number, which is today used as an eKYC. So once that was done, the government forced banks to open bank accounts with every household in India. In 2 years, 400 million bank accounts were opened. Why it was possible was that your KYC was instant. It was virtually no cost. What used to be $20 for opening a bank account today happens at less than $1. Once that happened, the second leg happened, which was the payment gateway. This is similar to Visa or a MasterCard, except it's low cost, it's virtually free, owned by the government. You can do a peer-to-peer transaction, merchant-to-merchant transaction, to the extent that the adoption has been humongous. Even a small cart owner will have a QR code. You can just buy one apple, pay 2 pence, and it's done. How it's transformed India is that today you have about 9 billion transactions a month happening on this gateway. 45% of global real-time transactions happen in India. That's the scale of adoption. And the third leg is where the government has created what is called the data layer. So today I have one app in my phone called the DigiLocker. All my documents, official documents, are uploaded onto that, right? From my driving license to my educational certificates, my birth certificate, everything that you really want is there on that one thing, and it's from the source, and you can actually share it. So how it's transformed India is that today, if a small shopkeeper had to take a loan earlier, banks wouldn't lend because they had no documentation or any proof. Today, you have something called an account aggregator. You give him a consent, and he'll pick up everything from the rent receipts you're paying, the electricity bill you're paying, your bank transactions, such that the banking system is now being able to lend to these borrowers. It's all paperless, and it's fraud-free. So what it's done is, what was rural and unbankable India has gone into the mainstream, and that's really driving a lot of growth in the economy. So what's happened is, once all this was infrastructure, the backbone was done, the government over the last 3 years has really been pushing for growth. They're doing it through 2 ways. One is infrastructure, which is where the government started spending on its own. Over the last 3 years, their own budget has seen a capex growth of almost 27% per annum, a pipeline of $1.8 trillion. And to give a perspective, if you're in a city of Mumbai, where I come from, there are almost $50 billion worth of projects being implemented simultaneously, right from a greenfield airport, 11 metro lines, you have a 22-kilometer bridge across the sea, 2 expressways running all the way to Delhi and a city called Nagpur in the heart of the city. And it's not just Mumbai. Delhi is getting a new greenfield airport. There are 25 cities where metro lines are being built. So that's the scale of investments that's happening. Also, to get the private sector into the animal spirits of investing, the government's actually come up with very tailor-made policies to encourage by giving incentives if you put in capacities. They've identified 14 sectors where either India's a very large market but importing everything, or B, India has a manufacturing strength and you want it to be an export hub. And it's had a lot of success. For example, in cell phones, India is a 180 million phone market. Until 4 years back, we were importing all phones largely from China. Today, 100% of imports phones are assembled in India. Everyone from Apple is shifting production to India. Motorola has shifted. Apple itself is already exporting phones worth $1 billion per month out of India. So both factors have really transformed what's happening in India. And you're seeing it in numbers. So it's really not wishful thinking. Your credit growth is at a decadal high, trending at over 15%. And it's across retail, corporate, small and medium enterprises. Tax collections are growing at 20% plus. First time in my history of 30 years of investing where I've seen that taxes are growing ahead of the government's own forecasts and budgets. If you see the chart on the right, this is the quarterly results I've just got over. And we've aggregated the order book inflows in the last quarter and compared it what's happened in the previous year. there's a 60% increase in order inflows for capital goods companies. They're sitting on $170 billion of orders, which is actually 3 times the sales of these companies in the previous year. So that's the sort of scale you've seen, and that's also giving you a lot of visibility on what's happening in terms of the ground level activity. And I thought I'll talk about one more slide, which is the real estate sector. And why I've mentioned this is because in countries like China, even in the US, the biggest worry is the real estate sector. In India, what you saw is for almost 10 years, real estate sales were flat, pricing was flat. And what happened in the process, income levels went up, affordability has actually improved, inventory levels have come down. So the real estate cycle has just picked up. In fact, last year was the highest ever residential real estate sales. And the trend we are seeing today is that the sector is actually growing at about 20%. And real estate is one of the biggest generators of employment in India. So you're actually seeing virtually every cylinder of the economy firing. And finally, the last leg of India is really consumption. And I started with the 600 million people workforce under 25. What's happening is India today has a per capita income of just $2,300. That's actually 1/6 of China. UK is somewhere around $45,000. So what I'm really saying is, once you get this growth going, all the income really goes straight into consumption. So India is actually entering a cycle of both investment and consumption-led growth, which gives us the big comfort of that what we are really seeing is not a 1 or 2 year phenomena, but we're actually looking at a 4-5 year steady 6 to 7% GDP growth. I thought I'll just address 2 big pressing issues which people keep talking about, especially with emerging markets. The first is currency. Whenever there's a global crisis, the first thing happens with countries like India is that the currency collapses. And historically also, this is the Indian rupee versus the US dollar. And every crisis, if you've seen the GFC, the taper tantrums, etc., the currency in a very short period used to depreciate almost 20 to 30%. But what's happened is since COVID, India's currency has actually just depreciated 11%. It's actually been less volatile, more stable than even the UK pound, which is really reflecting the change in the external position. And why that has happened is that India today is sitting on forex reserves of almost $600 billion. That's the 4th highest reserves in the world. And one of the big reasons behind that is that India is attracting a lot of foreign capital, foreign direct investments. It's almost $65 to $70 billion a year. So it's really shored up your reserves. And unlike, I would say, foreign portfolio investments which come in and go out, this is steady. And I would say it's really providing that comfort to the central bank to be able to manage the currency without having too much of issues. The same goes for inflation. The 2 gray lines you see is the central bank's band of where it wants inflation to be. It's between 2 to 6%. And India's inflation, which is the dark blue line, has been in that range for quite some time. In fact, interest rates in India peaked in February. And since then, it's the central bank is just waiting to bring down the rates. But it's really dependent a bit on what's happening in the US market. So they don't want to start lowering rates if the US is still raising rates. So that's really, I think, the bigger picture. I think India's on a very strong wicket. And we are really in our fund trying to capture this story. So what do we do? As I mentioned, we are based in Bombay. We are very bottom-up investors. If you see, almost 90% of our portfolio is off benchmark. When we invest, we really look at buying a business with a 3 to 5 year holding period. And today, I would say over 60% of my portfolio is I've held for well over 5 years. Our portfolio turnover is very low. Our own belief is that India, there's no shortage of growth opportunities in India. What you really need to do is play with the right management, buy businesses where there's no corporate governance issue, dynamic management, buy businesses which are scalable, and which have some USP which gives it an entry barrier and the confidence that the earnings will be predictable. And finally, we are very cash flow focused. If a business has not generated free cash flow in the past, we just assume it'll never do it in the future. So it's a very, very process-driven, very, I would say, a bit lazy investing, where you just try and find one good new idea in 2 to 3 months, and your job is done. So how do we invest? I've tried slicing and dicing the portfolio into 4 buckets. But the core is really to buy businesses in this category, which is our consistent compounders. And all these businesses I've highlighted here, I've owned for almost 10 years. These are businesses which are steadily giving an earnings growth of 15 to 18%. For one example, PI, it's an agrochemical company, but it's compounding at 20% per annum over the last decade on earnings. And what we are really trying to do is buy these quality businesses which really play a drive on the India growth story itself. Where we are investing now is in some of the newer age businesses. These are playing on the new themes which are happening. For example, Sona is an auto ancillary company. It's playing the EV story. It's suppliers to everyone from Tesla to 5, 6 platforms in Europe and the US. High visibility. Anytime they get into a new platform, and it's a very complex product, you have almost 8 years of visibility on orders. Likewise, Dixon, I mentioned the cell phone story. They're like the Foxconn of India. They're the largest manufacturers of electronic manufacturing. They supply to everyone from Samsung to Motorola to Nokia to Philips, Panasonic, growing at again 35-40%. What I'm really trying to say is that while we play in the mid and small cap segment, almost every stock in our portfolio are leaders in their own segment, which gives them that pricing power and that sustainability on growth. We're also trying to ensure we are there in all the right themes of the market. And I've tried identifying some areas where we are seeing a lot of opportunities. I talked about digitization. We have possibly the best, highest rated retail bank in India. In consumer businesses also, what you're actually seeing is a lot of efficiency gains which are coming in both on the back end and the front end, as they're being able to actually, because of technology, being able to address a section of the market which earlier they found too expensive to service because of low pricing power. A big opportunity in reallocation of supply chains. We are seeing it across portfolio companies, right from electronic manufacturing, agrochemicals, auto ancillaries, industrials. In fact, some companies tell us that, for example, Skipper, it makes transmission towers, telecom towers. They tell us that today what's happening is from orders from the US, the criteria of the tenders is that you can't have a single component sourced out of China. From having zero business in America, he's winning huge business out of America. He's become the biggest player in Australia, which still 3 years back sourced everything from China. So that's the sort of opportunity opening up to India. And if you look at India versus China, China in every product category is almost 10x the size. So what you're really looking at is a small proportion shift to India, and it's really doubling the market opportunity for some of these companies. Likewise, consumption is our biggest theme. It's always been the case, and we really, almost 25% of our portfolio is always deployed in this sector. Here we are seeing both staples, discretionary, everything growing because of the growth. And finally, the CapEx story, which we are playing through banks, suppliers like cement companies, industrial companies. Just look at our own portfolio in aggregate. What I'd like to highlight is the table, the first line on the table. And if you look at the earnings growth of the portfolio, we are seeing an earnings growth of almost 25% in the current year, next year as well. Last year, the aggregate earnings grew at 27%. What I'm really trying to say is the numbers I'm talking about, the growth is actually getting reflected in the portfolio as well. And it's actually not being driven by one or two sectors. It's actually across the board. Today, I would say virtually every sector in India has a story, which is what's driving this sort of growth. Look at our performance. The earnings growth is actually reflecting in the performance itself. We've almost doubled in the last 3 years in terms of valuations. And I think at a multiple of 17.5 times, while it's higher than our previous multiples, I won't say it's in a zone where it's excessively overvalued. I'll end by just addressing a few queries on valuation, because whenever we speak with investors, they all say, yes, we love the India story, but it's expensive. So I thought I'll just put it in perspective. Yes, India has been a great performer, especially in the mid and small cap space, where then it's been the best performing market, I would say, in this year. And even on valuations, the chart on the left is the price earnings multiple of the MSCI India index. What you see is it's actually trading above its historical averages. More importantly, if you see the slide on the right, the blue line is India's performance versus the emerging market performance, and the gap has only widened, which really is showing that the India premium to emerging markets has increased, which is where people are kind of worried about the risk reward between India and other emerging markets. But there's a reason behind this, and this slide shows the fund flows into the Indian equity markets. The gray line is money flowing into domestic equity mutual funds by retail investors. What you're seeing is there's a steady inflow of money into Indian equities in the domestic funds. The blue line is foreign institutional investors flowing into Indian market, and that's been volatile. Last year, almost $30 billion went out of India. This year, you had, it's been a trend where it goes up, it goes down. But effectively, in the last 2 years, you've actually seen outflows from India equity market. So foreigners have actually been pulling money out, yet the market has done well. And the reason behind this is a very simple one. This chart here shows systematic investment plans, investments into Indian equity funds. These are retail investors from tier 2, 3, 4 towns. 73 million such investors putting in on an average £20 per month from their salaries into a mutual fund. It's very steady. For 4 years, every month you've seen an inflow of $1 billion plus. Today it's trending at over $2 billion per month. So really India's volatility due to foreign investors has actually come down. The domestics are bigger drivers, and I think that's a very healthy sign for the market. I'll end with this one slide, which gives India's performance over long-term time periods. And these are pound returns. The BSE 30 is the top 30 index and the midcap index. What you'll see is over long-term periods, India's actually delivered. It's the best performing market ahead of even the S&P in the US. And the reason behind this is very simple. Even in the past, despite the reforms, etc., India's GDP in dollar terms over a decade has actually grown at almost 10% per annum. So what the markets are doing is simply tracking the GDP growth. And my belief is we are actually trending to a higher GDP growth trend given the sort of reforms and the structural changes we've seen in the economy. So really, I'll end there and say that don't get carried away by valuations in India simply because that's a one-year phenomenon. The growth is much longer. And from a structural perspective, I would say India is a much longer-term story, and it's possibly going to be, as they say, the third largest economy in a matter of a decade. I'll end there and take some questions.
Thank you very much. Thank you. Okay, so if you have a question, please raise your hand, and my colleague Chris will come over with the microphone. So here in a second. I'll take one as well, Chris.
Hi there, Gaurav. Huge congratulations on the, I see, 14% annualized return over the last 5 years.
It's 10 years, 11 years.
Yeah, okay. So let's anticipate a slight slowdown in that return over the future period. What could cause this, and what are the biggest risks? That's question number one. And question number two is, you have a very high cost charge of approximately 1.62%. Is the board putting in place steps to bring that down?
Yeah. So on the risk factors, I'm not so worried about growth. I think all the ingredients are very much in place. If any risk there is largely global, that if you have a recession in the US and Europe, it will pull down the growth to some extent. Having said that, India's less levered to the global markets. Our exports is only 1.8 or 1.9% of global exports, unlike, say, China, which is 20% plus. And 2/3 of our GDP is really a domestic-driven GDP. So yes, growth could come off, but it will still be one of the better markets to play. I think the short-term risk is really that we do have general elections coming in May. And one of the things I started off with was that what's driven all this is that we had a single-party majority which could take decisions. Now, current opinion polls and the popularity of the government led by Mr. Modi is very, very strong. I mean, there's a belief that he's definitely going to come back, but 6 months is a long way off. And clearly, all the opposition parties are trying to gang up and fight as one unit against him. So should that happen, that this government loses elections, I actually see a very sharp negative reaction in the short term. But if you look at the longer term, I would say the next 3-4 years, the earnings growth story should stay strong because the reforms and the changes implemented will sustain the growth momentum. What may change is if a new government and it's a coalition government, then you still need a lot of incremental changes to sustain that growth beyond the next 3 years. And that may upset the calculation. So I think election is something to really watch out for. And but the current trends are that it's going to be a handsome win for this existing government. To answer your second question, it's a tough one. What we've done is, I would say I've now been running this for 12 years now. When I started the fund, we were at a 20 to 24% discount. So we spoke with investors, and investors said, you're listed on the AIM exchange, move it to the LSE. We did that. Then we created a provision for a buyback. I did extensive marketing, going a lot onto the retail side. And then we also, another advice was, you have a high discount. Why don't you charge your fee on the market cap and not on the NAV? So the idea is that you're also incentivized to get the discount up, which we actually did. So today our fees is not on the market cap, on the NAV, it's actually on the market cap. So the higher the discount, the less our fee. So while we charge a fee of 1.25%, it's effectively a lot lower. It's I would say average is about 1.1%. And we've been very successful. Whatever investors have told us, we've tried delivering, which is why if you see over these 10 years, from a 20% plus discount, today in the last year, we've been at about 5 to 6%. So yes, but the board is always conscious of it, and that's a discussion all the time. But I would say, we spend a lot of time trying to ensure that, I think for us, performance is key. And I'm hoping we continue with the trend. If we suffer, yes, I'm sure there'll be a lot more pressure from the board on us. But right now, I think we're not getting too much flack for our high fee structure. I think the focus is more on trying to show the performance is consistent and we deliver on that.
Thank you. Next question, just over here. Thank you.
Hello. Can you tell me, please, how does the company compare to its peers, and particularly to Ashoka?
Okay, so I'll say there are 4 India funds. There's Ashoka, there's us, there's New India, Aberdeen New India, and there's JP Morgan. In terms of performance, I would say we are the best. We are fairly differentiated because we are also the only specialized mid and small cap fund in that space. In terms of discount, I think both New India and JP Morgan are at about a 20% discount. We are at about, 4 to 5%. And Ashoka is a bit at a premium to a marginal discount. I think what they do have is they have an annual redemption window, and they also don't charge a fee. I think that's the big difference. They take a big performance fee. But having said that, our performance, I think they started with a very strong track record, but I think today we are ahead of them even on a 3-year return.
Question here, please. Sorry, Chris. Thank you. Thanks.
In investing, from time to time, the wheels fall off the bus, and you've obviously got the political scenario to look forward to, or not. Looking at the past performance of the business, when we hit into COVID, you, in comparison with the other 4 companies, 2 unit trusts and 2 investment trusts that I track and trade in and out of to an extent, you fell to a 40% discount at that point in time. I'm not entirely ungrateful for that because I bought a chunk of shares at that point in time and to an extent regret having sold them at a trebling thereafter. So I'm not ill-disposed towards your company in any shape or form from that point of view. But have you changed the positioning such that there may be a greater resistance to fall in the or an increase in the discount in the event that things do run badly in the next year?
I think that's a bit of a nature of the market. Whenever there's a lot of volatility and concerns, the mid and small caps fall more. And even from the trust side, it's not as liquid, so the trust also falls a bit more. Having said that, what we are building is a very, very strong quality portfolio. So when COVID happened, we really did absolutely nothing to our portfolio. We had negligible leverage in our portfolio. All our businesses were cash flow positive. So what we did was we just deployed more of our capital into our existing companies. And for example, there's a company called Ramkrishna Forgings, an auto ancillary company. Its stock fell from almost 180 rupees to 40 rupees. We just kind of doubled up. And today, this year, one of our reasons we've done so well, it's actually run up 250% in this year itself. So what we are trying to do is ensuring that the quality of the portfolio is so strong that we don't have any stress on the portfolio side. The volatility we try and use just to, as you said, we also use it to our advantage, that if things fall off, I would say we trade very little, but we know our portfolio companies inside out. I would say we are if we own a company, we'll know it better than anyone else. So, for us, it's an opportunity. But we can't hide from the volatility which happens in mid and small caps. It's something you got to live with. But you got to trust the fact that because of the volatility, we try and ensure that we have absolutely no issue with governance on the companies, with cash flows of the companies, that, when things go wrong, you start wondering, what should I do with the company? Our first mindset has always been, when we invest, is what if stocks come off? What is your first mindset? Would you be buying more or would you be thinking of stress?
Can you also comment on your current and possible future thoughts in terms of gearing, and also whether, if the shares do fall to a significant discount, you'd be inclined to buy any in?
Yeah, I think on gearing, I'd rather play it through the portfolio. I try not to take market calls, frankly. So for me, if I'm very bullish on certain segments of the market, I'll just add weights to my portfolio in that segment. And possibly if I'm very negative on the market, you'll by default come into a bit more cash because I'm selling some companies which are slightly expensive. So I'd rather play it through the portfolio. And in my 30 years of investing, I've learned the hard way that taking cash calls or taking very aggressive calls on the market direction is not my cup of tea. So I stick to that bit of it. Regarding buybacks, I think we are a very active board. So we've always, if the discount goes above a particular level, we have in the past done buybacks to get the discount back up. I think the board is very, very conscious of ensuring that the discount doesn't go beyond a particular level. So we've done that in the past, and I think if we have a situation where, again, the discount goes beyond double digits, I'm sure the board will take some action on that. That's actually the call of the board. But for them, I think one of the prime key criteria is that to manage the discount.